Hey everyone, and welcome to another episode of Brett's Brain. Today, we're going to do a deep dive into the convertible debt note. Hey, I'm Brett Roll, former entrepreneur, current venture capitalist. Thanks so much for checking out the channel. Our goal here is to help entrepreneurs succeed, so make sure you share, like, subscribe, do all those things, and ask us questions if there's something that we can be helpful with down in the comment section below. Okay, the convertible debt note. It's one of the three main ways people invest in startups today. So there's the priced round, which is just you're giving out equity at the moment of investment. There's a safe round, and then there's a convertible round. Both safes and convertible debt rounds are basically promises for future equity. They do them in slightly different ways, and we've talked about the differences in past videos or in other videos. Today, we just want to focus in on the convertible debt note. The history of the convertible debt note real quickly. It was started because it was supposed to be a simpler form or a simpler way to get investment from investors. It was quicker, less expensive from a legal cost standpoint because you had less pages of documentation. There's less things to agree to because the people that were investing weren't actually becoming equity holders at that point in time. It also was a way to try and avoid having to set a firm valuation in your company. And so there were some real benefits and there were some real good reasons as to why the convertible debt note. And then the safe note, which became popular a little bit later, became really popular, especially for early stage companies where the investors didn't really care as much about some of those controlling provisions or some of the benefits that they might get by holding equity at the beginning. Okay, so a couple key things you need to think about in your convertible debt note. One is you're going to potentially have a valuation cap. The second is that you might have a discount. And the third thing that you're going to often see or always see is that there's going to be an interest rate and a maturity date on your convertible debt note. And so those are a couple things that you should think about and really understand, why they're there and how they work. So the valuation cap is pretty simple. So the valuation cap says we are promised as investors that no matter what you raise your next round at, our valuation won't go above this cap. And so if I put a valuation cap, or I agree with an entrepreneur of a valuation cap of $10 million, then even if they raise their next round at $100 million, when we convert, the highest valuation we would get in that company is $10 million. And so that's a real simple explanation of how a valuation cap works. The discount is kind of similar. So it says, no matter what you raise your next round at, so let's pretend that we have a 20% discount on a convertible debt note. No matter what valuation you raise your next round at, we are going to get a 20% discount on that valuation when we convert. So if you raise your next round at a $20 million valuation, we would convert at a $16 million valuation for being really simplistic, And so that's how that discount would work. In most cases, we see that convertible debt notes have both a cap and a discount on them, especially in the current macro right now. But really, honestly, almost always we see convertible debt notes having both a discount and a cap placed on them. And the way they're usually worded says that the investor gets the lesser of the two. So if my valuation cap is lower than what my discount would be, then I'm going to get the valuation cap. If the discount is lower than what the valuation cap would be, then I'm going to take that discount. And it's almost always at the choice of the investor, not the entrepreneur. And they're almost always going to take the lesser of the two. And so that's how the valuation cap and the discount work. And I think those are actually a little bit more well understood. And there's a lot of time spent thinking about those two things when entrepreneurs are out raising rounds and closing capital on a convertible debt note. A little bit less time is spent on the maturity period and on the interest rate. Now, convertible debt notes are debt. They're actually debt. So it's not just equity. Theoretically, they could be called and have to be repaid in full. And so it is a debt note. And there is no guarantee that the debt holders will convert to equity. Now, in practice, it almost always happens. But you might have a 12-month maturity, an 18-month maturity, or a 24-month maturity. Those tend to be the three most common. And so if a round of capital that is qualified isn't raised before the end of the maturity date, then you have to go back to the table with that investor. and you have to renegotiate in some cases. In most, the investor just extends the maturity date. So you didn't raise a qualified round of capital in the 18 months you had, which would trigger an automatic conversion. So, which is usually built into these, where the investors have to convert as long as you raise a qualified round, which is usually just you have to raise at least $1 million or an amount of capital you would have to raise, which would trigger an automatic conversion. But sometimes that doesn't happen. Actually, frequently it doesn't happen. And so you get to that end of that maturity date, that 18 months, and now, theoretically, an investor could call that capital and say, hey, we want to be repaid. We don't want to convert. And in most of those cases, the company doesn't have enough capital to pay that entire debt borrowing or that money they borrowed back because they expected it to convert to equity. And so it could bankrupt a company. It could put a company out of business, which is why in practice it doesn't often happen, because most investors would prefer to continue down the path to give a chance of getting some sort of return when they know at the end of a runway the company doesn't have enough money to be paid back. But occasionally what happens is that an investor might use that leverage to try and renegotiate a cap or renegotiate a discount at the end of that maturity date. Again, doesn't happen frequently, but I've seen it happen. And for that reason, I actually now recommend that founders use safes instead of convertible debt notes. But if for some reason you're stuck on using a convertible debt note, then just be aware that that could happen, that does happen, where an investor could say, hey, we're going to call this capital unless we get a little bit better terms because things are more risky for us now, or something like that. And again, it's not something that most venture funds do. It's not something that most investors do, but it is a fringe case that you do see happening. And it's not very founder friendly, but it could happen. So you got to be aware of it. And so that's what the maturity date does. It's the maturity date of when the loan is due if the investor chooses to call that money. Now let's quickly talk about the interest rate. So when you sign up for a convertible debt note as a founder, something on there there's an interest rate built in. And now you're not actually going to, in most cases, you're not actually going to be paying cash out on the interest rate. So if I invest $100,000 and there's a 8% interest rate on that convertible debt note, it doesn't mean that you're going to be paying me $8,000 or 8% of $100,000 every year in cash. It actually compiles and compounds every year. And so after 1 year, I've now got $108,000 due. In the subsequent year after that, I've now got about $117,000 due to me. And it keeps compounding and compounding until the conversion. And at that time of conversion, what actually happens is now instead of just converting $100,000 in at that cap, I convert in that $117,000 at that cap. So if you end up having a $10 million cap and I invested $100,000, I'm not going to own only 1%, 100,000 into 10 million. I'm going to own 117,000 or 1.17% of your company at the time of conversion. Now, if you have convertible debt notes that are outstanding for 2, 3, 4 years or an incredibly high interest rate, that can really build up and cost a lot more equity at the back end of the conversion than what you're anticipating. And most people just have in their brains how much they raised. Oh, we raised $1 million or we raised $2 million in convertible debt notes. And you just think 2 million. But now it's been outstanding. You had a 10% interest rate and it's been outstanding for 2 years. You actually are going to be converting in to over 2.4 million in that case. And that can cost you real percentages of your company at that point. And so it's just something to be aware of. Convertible debt notes definitely serve their purpose and can be a really useful tool for a founder. But there's these two unique things, which is that maturity date and the interest rate that a safe note just doesn't have. And so safe notes tend to be a bit more founder friendly than a convertible debt note can be. And so again, this is why I recommend that founders go the safe note route than the convertible debt note. And the other reason to go safe versus convertible debt is that honestly, like convertible debt is debt. And when you invest on a convertible debt note, at the beginning, at that time of investment, everybody expects to have equity at some point. We are investing not to get paid back our debt or that interest. We are investing to get equity in this company. And so why not use a path that is specifically made for that, like priced round or a safe note? Because we don't expect to get paid back. And so why use a debt facility? And at the beginning, we started with debt facilities because that was the best thing available to us. And so, if you do go that path as a founder, just make sure you're aware of the ramifications of a couple things. Hopefully this was helpful. If you like this, make sure you share, like, subscribe, and ask us questions down below.